The EV industry has a lot to learn from Tesla's latest earnings report. After beating both top line and bottom line estimates from Wall Street, Tesla stock is down almost 10% for the day after investors dismissed a lot of the headline beats for more accurate measurements of how the business could be performing. As we all know, Tesla has this kind of aura around it that no other EV automaker really does. No matter if you get good news or bad news, Tesla always has a lingering effect on other EV stocks and their respective business performances, and its latest Q2 earnings report is undoubtedly going to be no different. Now, I'm sure most of you already know the gist of the numbers that Tesla put out. Tesla is undoubtedly one of the most popular stocks in the retail investor community, and especially on stuff like Twitter, there seems to be a massive community and potentially cult around the investment thesis of Elon Musk and Tesla. So it's no surprise that news tends to spread like wildfire around this company. And so instead of doing that, let's just dive right into the raw numbers and let me give you guys my take on the red flags and as well the green flags of Tesla's latest report. So first things first, folks, let's discuss margin. For those that are unfamiliar, margin is essentially the percentage of revenues that you keep from the revenue you actually generate. And it's been historically known that Tesla has some of the best gross margins in the industry. And that is completely true because since 2020, their average margin, as you can see right here, has been anywhere from 25% all the way down to 18% in the most recent quarter. And although at 18% it is still a very healthy number, this trend is not really a good sign. And what most analysts expected is that Tesla's operating margins, which discount operating expenses and any income from operations, to stay above 10%. And as you can see, although they have stayed above 10% since 2022, in the latest quarter, it fell to 9.6%, which is a 493 basis point decrease from this time 1 year ago. Now, although the gross margin can be attributed to lower costs and the company reducing its average selling price, the operating margin should actually stay relatively stable for a company as big as Tesla. As you all probably already know, the reason most people buy Teslas is not because it's a car that is electric. There are plenty of EVs out on the market, but people mostly revert to Teslas because of the simplicity, the cool factor, as well as the software. This is undoubtedly one of the reasons why Tesla has always had a very good margin, because what people are buying Teslas for is their full self-driving, their autopilot, their touchscreen, their integration, and all the cool features that come with it. And this is certainly unique to only Tesla, and there's unlikely going to be any other automaker that comes out, even in the EV space, that's going to be able to replicate the monstrous footprint that this company has set in place. However, the issue is, and something we're clearly starting to see, is that that footprint is not as sustainable as many people are expecting. Although the company produced $1 billion in free cash flow, which is fantastic, it is not meeting up to the expectations that investors and even business analysts have set forth for this company. And why exactly do I believe that? Well, folks, because we have never seen an EV adoption race quite like what we're experiencing in the modern era. And it turns out that electric vehicle powertrains potentially are a lot simpler to manufacture and scale up than internal combustion engine ones, which means EV startups will naturally have better profit margins than those of traditional OEMs. And yes, those profit margins are not going to be restricted just to Tesla. As you can see, gross profit for Tesla's automotive and service businesses increased only incrementally, even though on a quarter-to-quarter basis, their revenue jumped pretty significantly to $24.9 billion. And although net income beat analyst estimates on an EPS basis, as you can see, that is most likely attributed to this one-time operating income expense, or in this case, gain, of $328 million. Over the past 3 years, we have never really seen anything like this on Tesla's earnings report, which means that over the next few quarters, this $300 million is likely not going to be factored into the net income. And as for what exactly this could be, it most likely has to do with foreign exchange adjustments as the dollar has crashed and as the euro has gained strength. And although something like the Tesla Model Y was one of the best-selling vehicles of 2022, leading indicators like total US inventory listings are showing a different picture, which yet again is shedding light on how the margin story for this company could progress. Although Teslas are still selling like crazy, people simply have less cash to spend on expensive vehicles. And let's be honest, most Teslas are still considered premium vehicles, unlike your Toyota Corolla or Honda Civic. This is resulting in order backlogs falling, and as used car prices are collapsing because of the recent price cuts, many consumers are getting less confident in the ability of their Teslas to hold value. Tesla's US order backlog stood at 11 days at the end of June, a dramatic decrease from the 27 days that was noted in mid-May. And although this isn't a problem isolated just to this company, it is being exaggerated for Tesla because of their significant growth and scale in this industry. Because as we all know, folks, the company that makes the most also has the most to lose, and that is something that becomes even more important when it comes to a stock that is up almost 80% for the year. This new data potentially means that Tesla is at the higher end of the S-curve of adoption unless the company cuts prices or introduces new models. And as we have clearly seen over the past 4 years, the company struggles quite a bit with the latter. Now, this doesn't necessarily mean that Tesla stock is a bad investment. All it means is that the returns that many people are expecting from this company might not play out over the next 5 years. Because as you can see from all the red right here, the company's valuation is already pretty stretched, and their growth, at least right now, is slowing down. At a price to free cash flow of 157 and a PE of 82, Tesla is trading at roughly 4x the valuation multiple of Apple. And as we all know, Apple not only is the biggest company in North America, but they also have some of the best profit margins in the industry of north of 24% compared to Tesla's 9.6%. However, folks, it's not all bad news, because if Tesla's success results in expensive multiples like it has right now, it also means that other EV startups in this space can potentially grasp a similar or a 50% multiple if they can execute at a similar pace of production that Tesla is doing. And although these companies won't have anywhere near the moat that Tesla has with its software and brand image, chances are these automakers are at the beginning of the S-curve of adoption, unlike Tesla, which is most likely in the late majority to the laggards phase. And that is exactly why I believe that this Tesla earnings report, although bad in the short term, shadows very well for the overall electric vehicle space. So what do you guys think? Am I right to say that Tesla is nearing the end of the S-curve of adoption, or are there potentially more catalysts ahead? And will other EV automakers follow in the margin and profitability footsteps that this company has laid out? As usual, folks, let me know your thoughts on the situation down below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.